Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. With me for our Beyond the News interview is Barry Larking, Special Counsel at IBFD in Amsterdam. On today's show, Mother Nature tries to mess with Texas. Is carbon good or is it bad? That may depend on where you live. And parliaments may make the law, but courts will always have the last word. These and more, including Barry Larking's interview with Tatiana Falcão, a member of the United Nations Subcommittee on Environmental Taxation, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week as reported in IBFD's Tax News Service. Despite indications that carbon emissions may have slowed a bit during a year of quarantines and lockdown, climate change has not stopped for the pandemic. By most indications, the world's governments are getting more serious about reducing their carbon footprints, with the biggest news coming from the Biden administration, which last week rejoined the Paris Climate Accords. Denmark has proposed a comprehensive set of tax measures, all designed to reduce that country's greenhouse gas emissions by 70% over the next decade. These include raising the depreciation limit for small and medium-sized businesses to invest in green assets, increasing the deduction for qualified research and development costs for green technology, and raising depreciation benefits for new assets, except for machines and vehicles that run on fossil fuels. Rowing in the opposite direction, however, is Mexico, whose economy relies heavily on producing and selling fossil fuels. The executive branch there recently extended tax credits to provide incentives for taxpayers engaged in exploring for and extracting hydrocarbons. The credits will run through the end of 2021. Nowhere is the reality of climate change more evident this winter than in those parts of the Northern Hemisphere where tourists usually flock to escape cold and snow. Last month, Spain saw its biggest snowfall in decades, bringing traffic and commerce to a virtual halt for more than a week. As we reported, Spanish tax authorities reacted by extending tax filing deadlines by 3 days. Last week, millions of Texans lost electric power, heat, and water, and many lost their lives when the worst winter storm in a century brought snow, ice, and sub-zero Fahrenheit temperatures to the entire Lone Star State. Recognizing the hardship that the extreme weather event brought to Texas businesses, the state comptroller of accounts has extended a number of filing deadlines for 7 days. We can only hope power is restored to everyone in time. We often report on tax developments from legislatures and parliaments that enact tax laws and finance ministries or revenue departments that administer them. This week's news reminds us, however, that when questions arise about the constitutionality or interpretation of tax laws, it is the courts that have the final say. The Supreme Administrative Court of Colombia recently ruled that the Colombian Tax Administration exceeded its authority when it issued a ruling denying tax deductions for interest paid on loans taken out to finance the purchase of shares. The court ruled that the interest is deductible as long as the loan meets the requirements of the statute, and it directed the tax authority to analyze each claim on a case-by-case basis. The Supreme Court of Brazil has ruled that liability for a municipal tax on the transfer of real estate is not, as the city of São Paulo contended, due on the execution of a contract to sell the property. Instead, the court ruled unanimously that liability for the tax does not arise until the deed is recorded. And in what might have been one of its busiest weeks, the Court of Justice of the European Union has issued rulings in a number of tax disputes across the bloc, including on double taxation of dividends in France, transformation of perpetual usufructs into full ownership rights in Poland, the classification of tax on customer deposits in credit institutions in Spain, and the classification of special purpose motor vehicles in Austria. And now moving on to other news. For the first time in its history, the African nation of Rwanda has enacted a law recognizing various types of partnerships. Although Rwanda's tax code had always treated partnerships as pass-through entities, this is the first time that the country has enacted a general partnership law. The government expects the new law to benefit private equity investors as well as businesses that have traditionally organized under the partnership model, such as law and accounting firms. Hong Kong has presented a budget that proposes a one-off 100% tax deduction in profits tax, salaries tax, and personal assessments for the 2020-2021 assessment year. Don't get too excited, though. The 100% reduction is limited to a maximum of 10,000 Hong Kong dollars, about 1,300 US dollars. And finally, as the old expression goes, if at first you don't succeed, try again. Well, what happens if you don't succeed at first, second, third, fourth, fifth, and on and on? Apparently, if you have enough money to pay your lawyers, you keep trying. 3 American sisters just lost their latest appeal in their efforts to keep the U.S. Treasury from getting its hands on millions of dollars in taxes they owe from the sale of a business in 2001. One might think that after 20 years and millions spent on lawyers, the Vento sisters might finally throw in the towel. Maybe, maybe not. Before we go to Barry Larkin for our Beyond the News interview, I wanted to share some exciting news from IBFD. We have just launched a new publication called Talking Points, showcasing IBFD's thought leadership through shorter commentary pieces. The first issue, Crossing the Digital Tax Divide, but is it worth the trip, from Vertex economist George Salis, is now available for free at ibfd.org. Check us out. And now we go beyond the news for Barry Larkin's interview with Tatiana Falcão. Barry.
Thank you, Stuart, for your informative news report. I'm Barry Larkin, Special Counsel at IBFD, and I'm delighted to have with me today Tatiana Falcão, who's a member of the United Nations Subcommittee on Environmental Taxation. She's also the author of a book calling for a multilateral carbon tax treaty that was published last year by the IBFD. So she's therefore the go-to person for an interview on carbon taxation. Welcome, Tatiana.
Thank you, Barry. Thanks for having me.
It may not be just coincidence that Stuart mentioned carbon tax in this week's tax news, because carbon taxation is hot and it's getting hotter. So it's high time we unraveled some of its mysteries. And let's start with a simple question. What is carbon tax and what's it supposed to do?
Right, so a carbon tax is a tax that is typically employed on fossil fuels, such as diesel, gasoline, natural gas, and coal. It is an excise tax, and it is levied on the polluting potential of the product, which is usually expressed in terms of carbon, which is what gives rise to its name. So a carbon tax is known to produce a double dividend to society. The first dividend would correspond to the revenue generation capacity of the tax, and the second would correspond to the environmental benefits derived from the reduction of carbon-based emissions under a business as usual scenario, so under normal circumstances.
So in other words, your double dividend consists of more revenue for the government and a cleaner planet, if I can sort of simplify it in that way, which sounds an ideal world. It also reminds me of this wonderful English expression of having your cake and eating it too, which is something which is not possible. In other words, you can't have both of these things. You have to choose. Isn't that the way it works? I mean, isn't there a conflict between those two goals of revenue raising on the one hand and discouraging pollution on the other? Because if you succeed in the first one, raising revenue, it means that you failed in the other, because you do need polluters to generate the revenue. So is it really realistic to talk about a double dividend?
Right, so it's actually an implicit characteristic of the carbon tax that the most successful carbon taxes will actually be the ones who generate the least revenues. And that's because you have actually succeeded in obtaining the behavioral result that you intend via the tax. So if you think about it, just to illustrate that behavioral effect, if you think about those three main fossil fuels, diesel, gasoline, and natural gas, diesel is more carbon intensive than gasoline, and gasoline is more carbon intensive than natural gas. So by inputting a price on carbon content, and it's usually measured in terms of tons of carbon, you're actually providing an economic incentive for consumers to purchase natural gas over diesel, because natural gas will be automatically priced at a cheaper price than diesel will. And so by obtaining that change in behavior from consumers, you're automatically also reducing your revenue generation capacity, But that's actually an intended result of the tax because you actually want consumers to change their behavior.
Right. The Minister of Finance will probably be disappointed, but the Ministry of the Environment will be happy. I think that's clear. It's not a question of passing the tax on to the consumers, which I think is sometimes, the perception, if I've understood you correctly. It's more confronting them with a higher price and therefore changing their behavior and persuading them to opt for a cheaper, cleaner alternative. Does it matter what's done with the revenue?
Right, so the carbon tax doesn't imply that they have to do something with the revenue. Earmarking of revenues is actually a topic that is deeply connected to the topic because ideally what you want is to do something that is to the benefit of the environment with the revenue. Yeah. But there are several ways in which revenues can be employed by countries where earmarking revenues is not a possibility. So one of the possibilities that is typically employed and that is put forward by countries that are introducing carbon taxes for the first time is to obtain compensating measures in order to alleviate the burden on lower income households. So if you think about it, carbon tax is actually an indirect tax. The burden is going to be passed on to the final consumer because that's the expected and intended operation of the tax. And so obviously it will impact more low-income households than it will high-income households. So ideally, in order for a carbon tax to be acceptable and not generate any uprisings as we saw recently during the Gilets jaunes movement in France, consumers that are most affected by the tax will obtain some form of compensation, which can either be through cash transfers, it can be through lower tax rates, but ideally, and governments typically do provide some form of compensation for these low-income households so that they don't feel so affected by the tax. Another typical way in which revenues can be employed is through the development of research and technology in which to sponsor new technologies, because obviously if you are moving towards a society that relies less on fossil products, you have to generate new forms of generating new energy, and so these types of actions are typically sponsored by governments, and so governments will typically try, especially from more developed economies and middle-income countries, they will try to develop some form of new technology in order to compensate for the loss of fossil resources. And these are all, again, the fact that this tax generates revenues is actually to the benefit of its operation, because it allows governments to actually have surplus resources with which to maneuver itself in order to move towards this kind of a green economy scenario.
Clear. Now, carbon taxes are a hot topic now, otherwise we wouldn't be talking about them. But are they actually new? How long have they been around, and which countries have them?
Well, carbon taxes are not new, although they are not widespread. Many countries, and those are the countries that are typically known to have had carbon taxes the longest, have been employing them since the 90s. So these are the countries that are known to have the highest tax rates of carbon taxes.
Now. Right. Did they start with high taxes?
No, so they typically start with quite a low carbon tax rate, and then they already in the initial preview of the legislation, they foresee increases in the tax rates that will allow them to obtain the kind of impact that they have now. If you will, Sweden is the top country, the country with the highest tax rate currently, and it started in the early 90s, and it's been on a progressive schedule up to the present moment, obtaining a very high price.
Okay, but why now? What's special about now? It's taken, they've been around for 30 years, but all of a sudden everybody's talking about them.
So there are a number of issues that have led the carbon tax debate to be quite a hot topic. Well, the first one is obviously that we are confronted with the climate crisis and we have to do something about it. The second one is that there are the sustainable development goals that are supposed to, that countries have to live up to. Amongst those goals, at least 6 or 7 are related to climate obligations, and countries have until 2030 in order to meet their expected goals. So the clock is ticking, and countries have to do something about it. So that's the second reason. And the third one is actually, the ongoing COVID crisis. Countries have been undergoing a scenario of economic recession, and they will need to think of new ways in which to recover from the economic crisis. And one of these new ways is actually the introduction of the carbon tax, because it would allow countries not only to raise new revenues, but also fulfill this environmental goal that and perhaps even lead to a path of growth that is resilient and sustainable, and switch behaviors. This can be a switching moment for most countries as they further develop in a way that is sustainable in the long term.
And are those also the reasons why carbon tax is now high on the EU agenda? I mean, does the EU have its own carbon tax?
Right, the EU itself doesn't have its own carbon tax, although many member states do. But yes, the EU is currently proposing a carbon border adjustment mechanism, which is supposed to work either concomitantly or parallelly to the European emissions trading scheme. Nobody knows yet, and so.
Right, so this is the famous CBAM.
It's the famous CBAM, yeah, and it will, the design is not out, but it can work either as a carbon tax that is employed at the border, so upon entry into the common markets, or it can work parallelly to the European ETS scheme, which is the emissions trading scheme, and work kind of like a price. But in any case, it'll have reconciliation issues that the EU will have to work out before it can put out a first draft to that proposal.
So the B in CBAM stands for border adjustment. It has something to do with the fact that the whole world does not yet have carbon taxes, and so there is this risk, like in corporate income tax, when it's called tax avoidance. In this context, I think it's called carbon leakage. But it comes down to the same thing, because we don't have a global carbon tax. You need something to protect those countries that do impose it. Wouldn't it be? I mean, is the solution then that we have a global tax? Is this something that the OECD should get on top of? And would that solve all the problems? And how do we do that? How do we achieve that?
Right, so the carbon leakage issue is actually about the relocation of businesses to third countries that do not impose a carbon tax. So that's what the CBAM is trying to avoid. And yes, it happens to exist or to be considered by the EU because we don't have a multilateral agreement in place.
So isn't that the solution then? I mean, how do we get that?
Well, yes, working towards a multilateral agreement could be one way in which to avoid countries from introducing mechanisms such as the CBAM. And also, at this early stage in which carbon taxes are being considered more fully and more seriously than they have ever been, it could, knowing our recent history with the imposition of digital taxes, where we tried to reach a common consensus on the introduction of a digital tax, and then we weren't able to get to the point where countries were happy with the common approach, and everyone introduced unilateral measures. This might be a repetition of the same issue. If we are able to introduce a multilateral carbon tax treaty at this early stage, we might avoid having unilateral carbon taxes that are imposed by countries domestically and require offsetting measures in order to compensate with other countries, running the risk of double taxation, and several other complexities that will impact the international tax system as a whole.
So I guess the message is read Tatiana's book, because that's where the solution of a multilateral carbon tax treaty is explained. Well, I think in an ideal world, you wouldn't need a carbon tax, would you? Because there wouldn't be greenhouse gases. So we'll have to set our hopes on a second best ideal world that maybe will include a multilateral carbon tax treaty. Our guest today has been Tatiana Falcão, amongst other things, a member of the United Nations Subcommittee on Environmental Taxation. Thank you, Tatiana, for helping demystify carbon taxation. And let's hope it becomes increasingly unnecessary in future.
Thank you for having me.
So that wraps up this week's edition of Tax Takes News and Reviews, the week's tax news in a nutshell. But before leaving you, don't forget to check out the first issue of IBFD's Talking Points on Crossing the Digital Tax Divide on IBFD.org. And from Stuart Gibson and myself, thank you for watching. Here's hoping your week is not too taxing.